Every day, billions of people go about their lives thinking money is simple. We earn it, spend it, save it. Yet almost no one knows who truly controls it. Behind the scenes, invisible hands manipulate entire economies. Nations rise and fall, markets crash or boom, and ordinary citizens feel powerless, all orchestrated by a single hidden force: central banks. Today, we reveal how these institutions quietly control every economy on Earth, and why most people will never see it coming. To understand today's financial system, we need to travel back over 300 years, to the birth of central banking. The concept started not as a public service, but as a private enterprise, a way for wealthy financiers to lend money to governments and, in return, gain extraordinary power. The Bank of England, founded in 1694, was the first central bank in the modern sense. Its mission seemed simple: lend money to the government to fund wars and infrastructure. But beneath the surface, it was far more cunning. By controlling the issuance of money, the bank could manipulate interest rates, manage national debt, and dictate the flow of wealth, creating a system where money itself became a tool of power. As centuries passed, central banks multiplied across Europe and the Americas. By the 20th century, they were no longer just intermediaries between governments and private lenders. They had become the ultimate economic authority. Central banks don't merely monitor currency, they create it. Through the practice of fractional reserve banking, they can lend far more money than they physically hold in reserves, effectively generating debt that fuels economic growth and dependency. This system offered governments a seductive advantage: the ability to spend beyond their means. Roads, armies, schools, and infrastructure could all be funded with borrowed money. But there was a hidden cost. Every dollar borrowed came with interest, a silent, invisible tax that citizens paid over generations. Interest on national debt became a mechanism of control. The more governments borrowed, the more dependent they became on banks, and the more ordinary citizens unknowingly contributed to the wealth of financial elites. This was not just lending, it was the birth of a system where money itself could shape societies, economies, and power structures across centuries. Central banks are often described as neutral institutions, tasked with keeping economies stable. But beneath this official story lies a system designed for subtle, almost invisible control. Their most powerful tools include interest rates. By raising or lowering rates, central banks can influence every aspect of an economy. Higher rates slow borrowing and spending, cooling inflation, but they also strengthen the value of debt for banks. Lower rates stimulate spending and investment, often inflating housing markets and stock prices. Every move affects millions, but the winners are always those at the top. Quantitative easing key. During crises, central banks inject trillions of dollars into the economy. On paper, this stabilizes financial markets. In reality, it inflates the value of assets like real estate and stocks, disproportionately benefiting the wealthy while leaving ordinary citizens behind. The 2008 financial crisis is a perfect example. Banks were rescued with trillions, while millions lost homes, jobs, and savings. Open market operations. Buying and selling government bonds allows central banks to control liquidity, the amount of money circulating in the economy. This isn't just bookkeeping. It's a lever of power that can dictate economic growth, control inflation, and shape financial markets, all without most citizens noticing. Currency and exchange rate influence. Central banks also manipulate the value of their currency on international markets. By strengthening or weakening currency, they can make exports cheaper, imports more expensive, or debt easier or harder to repay. These decisions ripple globally, affecting emerging markets and developing nations far from the bank's home country. Every tool of central banks is a subtle hand on the global economy. Recessions, booms, inflation, and deflation are not random. They are carefully orchestrated outcomes. Ordinary citizens often perceive these changes as chance events or government mismanagement. But in reality, they are guided by invisible levers controlled by central bankers. Through these methods, central banks maintain a delicate balance. They make economies appear free and dynamic. Yet, they subtly shape who wins, who loses, and who remains dependent. In essence, they don't just manage money, they manage the fate of nations and the wealth of generations. While central banks influence economies through interest rates and monetary policy, their most powerful tool is debt itself. A silent, invisible chain that binds nations and citizens alike. Governments rarely have enough money to fund their projects, wars, or public services. So they borrow often from central banks or private financial institutions, creating new money that didn't exist before. On the surface, this seems practical, even necessary. But there's a hidden cost. Every borrowed dollar comes with interest. This creates a cycle that can never be fully broken. Countries borrow to repay old loans, often at higher rates. Over time, debt compounds, growing faster than GDP. Take Japan, for example. With a debt exceeding 250% of its GDP, it remains technically solvent. But nearly every citizen indirectly funds this massive obligation through taxes and inflation. Yet Japanese banks and international creditors continue to profit endlessly. Debt is also used as a political lever. Nations under heavy debt pressure are forced to implement austerity measures, cutting public spending, privatizing essential services, and raising taxes. The burden falls on ordinary citizens, while banks and creditors reap the benefits. The 2010 Greek debt crisis is a stark example. Pensions slashed, unemployment soared, yet international banks profited from Greek bonds. Even on a global scale, debt ties nations together, creating dependencies that limit sovereignty. Developing countries often borrow from the IMF or World Bank, using loans that come with strict conditions. These loans ensure the country follows policies favorable to creditors, not necessarily its own citizens. Debt is more than money owed. It's a tool of control. It shapes national policy, manipulates economies, and ensures power remains concentrated among those who control capital. For ordinary people, debt is invisible, yet omnipresent. From mortgages and student loans to taxes that repay interest on national borrowing. It is the quiet engine that sustains the invisible web of economic control. Central banks do not operate in isolation. While most people believe each bank manages only its own country's economy, the truth is far more intricate. Across the globe, central banks coordinate their policies, creating a network of influence that shapes international markets, trade, and even political decisions. At the center of this network is the Bank for International Settlements, often called the Central Bank of Central Banks. Founded in 1930, the BIS facilitates cooperation between major financial institutions, ensuring that policies across nations align to protect the system as a whole. Through secretive meetings and closed-door agreements, decisions made in Basel can ripple across continents, influencing interest rates, currency values, and national debt strategies. When the Federal Reserve raises interest rates in Washington, it isn't just the United States that feels the impact. Emerging markets often experience capital flight, currency devaluation, and rising debt costs. A decision made by the European Central Bank or the Bank of England has similar global consequences. What appears as market volatility or economic instability is often the intended effect of coordinated monetary policy. Central banks also maintain influence through the control of currency reserves. Nations hold foreign currencies, often dollars, euros, or yen, as reserves to stabilize their own money. This gives the issuing central banks enormous leverage, allowing them to indirectly dictate economic outcomes in other countries. Even financial crises are not purely accidental. Policies, bailouts, and stimulus packages are designed to maintain the power and liquidity of central institutions. Recessions, defaults, and market crashes, while devastating for the average citizen, often reinforce the control central banks hold over global capital flows. This invisible coordination ensures that no major economy can act entirely independently. Decisions, crises, and recoveries are all interlinked. Nations may appear sovereign, but their economic fate is, to a significant extent, guided by a handful of central bankers and the institutions that unite them. In short, central banks don't just control individual economies, they orchestrate a global financial system, guiding the flow of money, credit, and debt across borders, ensuring that the invisible web of economic power remains intact and unchallenged. So far, we've seen how central banks influence money, debt, and economies around the world. But how does this affect you, the everyday person? The truth is, almost every financial decision you make is impacted by these hidden powers, whether you realize it or not. Inflation, for example, is not just a rise in prices, it's a deliberate side effect of central bank policies. When governments and banks expand the money supply, the value of your savings quietly erodes. That paycheck you worked hard for loses purchasing power over time, while asset prices, stocks, property, and commodities rise, benefiting the wealthy elite. Loans, mortgages, and credit cards are another layer of the chain. Every payment you make flows into a system designed to enrich financial institutions. The average person is trapped in a cycle of debt, while banks grow stronger, creating a persistent imbalance that few ever question. Even investing doesn't guarantee independence. Central banks manipulate interest rates and market liquidity, meaning that stock and bond values are influenced not by companies' performance alone, but by monetary policies determined in secret. Ordinary investors are at the mercy of decisions made behind closed doors. Debt, inflation, and interest rates may feel like abstract economic concepts, but they directly shape your financial freedom, opportunities, and long-term security. Every economic crisis, every sudden market downturn, every unexpected rise in living costs is part of a system carefully engineered to maintain control. The key takeaway is this: awareness is your first defense. Understanding how central banks operate, how they coordinate globally, and how debt cycles manipulate economies, gives you the power to make smarter financial choices. While you may not control the system, knowledge allows you to protect your wealth, plan strategically, and navigate a world where money is far more than just currency. It is a tool of influence, control, and power. Now that you know the truth, the choice is yours. Stay in the dark, or take control of your understanding of money and power. Subscribe to our channel for more insights into the hidden forces of global finance. And follow a U.S. financial historian to uncover the secrets history tried to hide. Knowledge is your greatest defense. Don't ignore it.